Alfa Romeo enters the period approaching 2026, burdened by a contradiction it has never fully resolved. It is a brand rich in racing heritage, emotional design, and loyal enthusiasts, yet structurally weak in the areas that determine survival in the modern automotive industry. Alfa Romeo is not collapsing in a dramatic or sudden fashion. It is eroding under the weight of chronic underperformance, inconsistent strategy, and mounting financial dependency, all of which steadily narrow its future options. The most fundamental problem is scale. Alfa Romeo operates at volumes that are far below what is required to sustain a global premium brand profitably. Development costs for modern vehicles have exploded because of safety regulation, emissions compliance, electrification, and software integration. These costs do not scale down gracefully. Whether a platform sells 50,000 units or 500,000, much of the engineering expense is fixed. Alfa Romeo spreads these costs across too few vehicles, resulting in structurally weak margins. This lack of scale feeds directly into cash burn and internal debt pressure. Alfa Romeo does not publish independent financials, but its performance is visible through repeated restructurings and strategic resets. The brand consumes capital without generating consistent returns. Each new product cycle requires fresh investment long before prior programs have paid back. In a capital-intensive industry, this pattern creates a cumulative burden that resembles debt, even when it sits inside a larger corporate structure. Product inconsistency has compounded the damage. Alfa Romeo has oscillated between ambitious relaunches and periods of neglect. Promising models have been launched with fanfare, only to receive limited updates and marketing support. Gaps between generations stretch too long. Momentum stalls, competitors move ahead. When consumers perceive uncertainty, they hesitate. Hesitation is lethal for a brand that relies on emotional appeal rather than rational cost leadership. Reliability, perception remains another unresolved drag. Whether fully justified or not, Alfa Romeo continues to carry a reputation for inconsistency in quality and durability. In the premium segment, perception often matters more than data. Buyers expect reassurance, not risk. Overcoming this legacy requires sustained excellence over many years. Short bursts of improvement are not enough. The financial strain makes such long-term consistency difficult to deliver. Electrification intensifies every existing weakness. Transitioning to electric vehicles demands massive upfront investment in platforms, batteries, and software. Alfa Romeo lacks the volume base to absorb these costs independently. Shared architectures reduce expense but also limit differentiation. When a premium brand cannot clearly distinguish itself technologically, it competes primarily on styling and heritage. That is rarely sufficient to justify premium pricing in a crowded electric market. Pricing power is fragile. Alfa Romeo vehicles often require incentives to maintain sales momentum. Incentives protect volume but erode margin and residual value. Over time, the market learns to expect discounts, and this undermines brand positioning while compressing profitability. Weak residual values raise leasing costs, forcing additional subsidies that drain cash quietly but relentlessly. Dealer network stability reflects these pressures. In many regions, Alfa Romeo dealers operate with low throughput and uncertain outlooks. Some are paired with other brands to survive. Limited sales volume reduces profitability and discourages investment in facilities and service experience. Luxury buyers notice these shortcomings quickly. Once the ownership experience falls short of expectations, repeat purchases decline. Operational morale also suffers under constant restructuring. Engineering teams face shifting priorities and constrained budgets. Suppliers encounter inconsistent volume forecasts and tight cost controls. This raises risk and reduces willingness to invest in innovation for the brand. Over time, Alfa Romeo risks falling behind not because of lack of talent, but because of lack of sustained commitment. Strategic clarity remains elusive. Is Alfa Romeo meant to be a true performance luxury brand, a design-focused alternative, or a niche emotional offering within a broader portfolio? Each repositioning effort has been announced with confidence, yet execution rarely matches ambition. Frequent strategy changes signal uncertainty rather than vision. Markets punish uncertainty. Debt pressure at the group level sharpens the risk. Capital allocation becomes a zero-sum game. Brands that demonstrate clear profitability or growth receive investment, while those that do not face greater scrutiny. Alfa Romeo's survival depends on its ability to justify continued funding against competing priorities. Heritage alone is not a balance sheet asset. The most likely risk is not immediate shutdown, but gradual marginalization. Fewer models, slower updates, limited market presence. Over time, the brand becomes a stylistic label rather than a robust manufacturer. Collapse in this context is not a headline event, it is a slow fading of relevance and capability. Please subscribe to our channel. We want to hit 1,000 subscribers this week. For consumers, Alfa Romeo's current condition introduces serious risk that extend well beyond aesthetics or driving feel. Purchasing a vehicle is a long-term relationship with the manufacturer. That relationship depends on financial stability, operational continuity, and confidence that the brand will remain fully engaged throughout the ownership cycle. When a brand operates under persistent strain, those assumptions deserve scrutiny. Warranty coverage remains in place, but experience matters. Brands under cost pressure often tighten internal processes gradually. Approvals may take longer, goodwill repairs may become less common, and disputes may increase. These shifts are rarely announced, yet they shape owner satisfaction in meaningful ways over time. Parts availability is a tangible concern. Lower production volumes reduce economies of scale. Unique components may be produced in smaller batches, increasing lead times and cost. For owners outside major markets, sourcing delays can extend repair times. This inconvenience grows as vehicles age and move beyond initial coverage periods. Software and electronic support are increasingly critical. Modern vehicles rely on updates to maintain performance, safety, and compatibility. A brand focused on managing cash burn may deprioritize updates for older platforms. Over time, vehicles can feel outdated compared to competitors, reducing resale appeal and long-term satisfaction. Depreciation risk is significant. Market confidence directly influences residual values. If buyers perceive Alfa Romeo as uncertain or niche, used prices will reflect that skepticism. Higher depreciation raises total cost of ownership regardless of initial purchase incentives. What appears attractive at purchase can become costly at resale. Dealer network stability affects daily ownership. Limited dealer density means longer travel distances and longer wait times. Service quality may vary as retailers operate under pressure. The premium ownership promise weakens when convenience erodes. There's also strategic uncertainty. If product lines are delayed, canceled, or repositioned, owners may face reduced ecosystem support. Even without abrupt withdrawal, prolonged ambiguity undermines confidence. Owners want assurance that their vehicle will remain part of an actively supported lineup. None of this implies that Alfa Romeo vehicles lack character or appeal. Many deliver engaging driving experiences and distinctive design. The issue is the durability of support and value. Emotional appeal must be backed by a stable corporate foundation to translate into confident ownership. From a forensic financial perspective, Alfa Romeo represents elevated risk rather than imminent failure. Its challenges are structural and long-standing. Consumers considering the brand should weigh passion against prudence. In an industry where capital intensity and technological change reward scale and stability, choosing a brand under sustained pressure carries consequences that extend far beyond the initial thrill of ownership. Please subscribe to our channel. We want to hit 1,000 subscribers this week.